All right, let's get right into it. We're going to break down one of the most powerful and frankly most misunderstood tax strategies out there, using rental real estate losses to legally slash the taxes you pay on your main income. It's a pretty sophisticated mechanism, and in this explainer, we're going to pull it apart piece by piece.
It sounds totally backward, doesn't it? How can a property that's actually going up in value, maybe even putting cash in your pocket each month, also create a loss on paper? That's the central puzzle right there. And understanding the answer, well, that's the key to unlocking a massive tax advantage.
So our whole goal here is to deconstruct this entire process. We're not just going to scratch the surface. We are really analyzing the specific rules, the actual tools that let savvy investors connect those paper losses directly to their W-2 salary or their 1099 income. Okay, first things first, we have to understand the biggest roadblock. You know, a lot of people just assume that if their rental shows a loss, they can just subtract it from their job income. But nope, that is not how it works by default. There's a big rule that stands right in the way. And this is it. This is the gatekeeper, the passive activity loss rules, or PAL rules. They were put into place back in '86 for one specific reason: to stop people from using losses from investments they weren't deeply involved in, like most typical rental properties, to just wipe out the taxes on their main job. So here's the deal. The tax code basically puts your money into different buckets. The PAL rules build a giant wall between your active income bucket, your job, and your passive loss bucket, your rental property. You can use passive losses against passive gains, sure, but that wall stops you from using them against your active income. And it is so important to remember that this is the default setting. If you don't take specific intentional steps, any losses from your rentals are just stuck. They're stuck on the passive side of that wall, completely unable to touch your main income. And this really puts it into perspective. Expert analysis shows that the Tax Reform Act of 1986 totally changed the game for real estate investors. It closed a massive loophole that high earners were driving a truck through. But it didn't lock the door completely. It just created a very specific set of keys you now need to open it. So, how do you get one of those keys? How do you legally bypass the PAL rules and just tear down that wall? Well, it turns out there are two main pathways you can take to get your rental activity reclassified from passive to active. This chart lays out the two options perfectly. On one hand, you've got real estate professional status, or REPS. Think of this as the heavy-duty, all-in option. It's a huge time commitment, really meant for full-time real estate folks. But then, on the other side, you have the short-term rental strategy. Now, this is the much more accessible route for most high-income professionals. The time commitment is way lower, and there are no crazy restrictions on your primary career. Okay, so you've picked your path to make your rental active. Great, but where do these huge paper losses even come from in the first place? This brings us to the engine of the whole strategy: accelerating depreciation. The main tool you need here is something called a cost segregation study. The best way to think about it is like this. Instead of seeing your property as just one big thing, a building, the study breaks it down into all its little individual pieces. We're talking carpets, light fixtures, cabinets, appliances, everything. So why on earth does that matter? Because with standard depreciation, you write off the value of a building super slowly, like a little trickle over 27.5 years. But a cost seg study lets you identify all those non-structural parts, which have much shorter depreciation schedules. We're talking 5, 7, or 15 years. This lets you pull huge deductions into the present. So, a typical study might find that a pretty big chunk of a building's value, maybe around 30%, is actually tied up in these non-structural components. By reclassifying that portion, you're basically taking years and years of future tax deductions and cramming them into the first few years you own the property. And the impact? Oh, it can be absolutely staggering. Looking at various case studies, it is not at all uncommon for a $1 million property to spit out a year one paper loss of over $200,000 after one of these studies.
Now that is the kind of massive, actionable loss you can use against your other income.
All right, let's put all the pieces together now. Because this isn't just about one little trick, it's a two-part play. You have to do both. You have to qualify the rental as active, and you have to generate a big enough loss to actually make a difference. So here's the blueprint. Step 1, you get the right property. Step 2, you use a method like the short-term rental rules to make it an active business in the eyes of the IRS. Step 3, you bring in the pros for a cost segregation study to create that huge front-loaded paper loss. And finally, step 4, you take that loss, which is now active, and apply it directly against your primary income, potentially saving you tens of thousands of dollars in taxes.
Let's recap the critical takeaways here. The power rules, that's the wall. The real estate professional or short-term rental strategies, those are the keys that unlock the door in the wall. And the cost segregation study, that's the powerful engine that creates the tax-slashing loss you need. It's the combination of all these pieces that makes the whole strategy work so incredibly well.
And that really brings us to the final question, the one you should be asking yourself. When you look at your own financial world, are your investments just sitting there passively, or are you actively structuring them to be as tax efficient as they possibly can be? Because honestly, understanding that one distinction, it could change everything.